There are some candles on a chart that don't just show price, they tell a story. They are rare, bold, and brutally honest. No hesitation, no pullback, no games, just pure, raw momentum carved into a single candle. Traders call them no-wicks candles. And if you understand what they really mean, you will begin to see the market in a way most traders can't. Today, we're going to break down exactly what they are, why they form, what they mean for market psychology, and most importantly, how you can use them to your advantage. This isn't going to be some shallow definition. This is a complete masterclass. By the end, you'll know how to spot them, how to trade them, how to avoid the traps, and how to combine them with other price action principles to create a strategy that actually works. So what exactly is a no-wicks candle? In simple terms, it's a candle that opens at one end of its range and closes at the other, with little to no shadows or wicks on either side. If it's bullish, it opens at the low and closes right at the high. If it's bearish, it opens at the high and closes right at the low. In other words, price moved in one direction from start to finish without any significant rejection from the opposite side. There was no back and forth, no fight between buyers and sellers. One side completely dominated. Now let's talk about the psychology behind it. Trading is not just numbers, it's human behavior laid out in candlestick form. A bullish no-wicks candle is the market screaming that buyers were in full control from the first tick to the last. Sellers try to push back? Not a chance. They didn't even make a dent. A bearish no-wicks candle is the exact opposite. Sellers had the wheel from open to close, and buyers were nowhere to be found. There's no hesitation here. This is conviction. This is dominance. This is the market showing you pure intent with zero confusion. But here's the thing. Not every no-wicks candle means the same thing. Some are breakouts, exploding through a support or resistance level with no hesitation. Others appear in the middle of a strong trend, confirming that momentum is still alive and well. Some happen after a long move in one direction, signaling a potential reversal where sentiment has suddenly flipped. And then there are the traps, the fake outs, where the candle looks like pure strength, but it's actually bait for liquidity grabs and stop hunts. If you're not careful, those are the ones that take your money. Oh, how do you spot a high-quality no-wicks candle that's worth trading? First, look at location. Is it forming at a key level on your chart? Is it breaking through a zone of consolidation or bouncing off a major support or resistance? Second, check the volume. Was there a strong increase in activity when this candle formed? Third, always put it in the context of the trend. Does it align with a higher time frame structure, or is it going against the flow? Because here's the harsh truth. A no-wicks candle in the wrong place can destroy you. But a no-wicks candle in the right place can print money. If it's at a key level, backed by strong volume, and in the direction of the higher time frame trend, then you may just have a high probability setup in front of you. Now, let's dig deeper into the traps. One of the most common is the false breakout. Price pushes through a resistance level with a clean no-wicks bullish candle. It looks unstoppable. New traders FOMO in. But the very next candle? Reversal. Price snaps back below the level, trapping all the breakout buyers at the top. Classic liquidity grab. The same happens on the downside. A bearish no-wicks candle breaks a support level. Everyone rushes to short. And then boom, price reverses back up, leaving the sellers wrecked. The lesson? Don't take a no-wicks candle at face value. Always confirm with structure, trend, and volume. Oh, how do we actually trade them effectively? Step 1. Identify the candle. Spot the no-wicks candle forming on your chart and make sure it's clean, with no upper or lower shadows that stand out. Step 2. Check location. Is it at a key support or resistance? Is it breaking out of consolidation? Or is it in the middle of nowhere? If so, ignore it. Step 3. Align with the trend. Always zoom out. If the higher time frame trend is bullish, you want bullish no-wicks candles. If the trend is bearish, you want bearish no-wicks candles. Step 4. Look for confirmation. That could be a volume spike, a market structure break, or even confluence with moving averages or other tools. And finally, step 5. Plan your entry and exit. You can enter on the close of the candle or wait for a slight pullback if you want a better entry. Place your stop loss just beyond the structure and target the next liquidity area.